Be Wealthy and Smart, episode 1262.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about what is going on with interest rates, because the Fed has been jawboning or talking rates higher. For the first time in 16 years, we have the 10-year Treasury crossing 5%. And that's directly attributed to Chairman Jerome Powell saying inflation is still too high. He's giving the expectation that another rate hike may not completely be off the table. And yet, that's not what the futures market is telling us. The futures market is saying there's a 95% chance of no rate hike at the next meeting. So there's a disconnect between perception and reality. Usually, the futures contracts get it right. But the issue is the 10-year Treasury is the barometer for mortgage rates and other types of loans. And when the 10-year Treasury goes up, it affects just about everything in terms of what consumers pay and how consumer loans are priced. So the main reason that the chairman is talking up interest rates is because he believes that inflation is still too high. So although inflation has come down a lot since September of 2022, when it was running about 8.2% for the CPI inflation, and it's been trending much lower than that ever since. But we hit a bottom in inflation in June at 3%. And then in July, we had a slight tick up at 3.2% inflation. In August, again, it ticked up to 3.7% inflation. But in September, we started the downtrend again, and it was slightly lower at 3.6%. But nonetheless, the Fed has a target of 2% inflation. So they are looking to keep rates high until they see inflation get back to 2% or below. But they also are acknowledging that it takes time for these interest rate hikes to play out, and it can take more than a year for some hikes to really be seen in the economy. So they also know that they have to give it time to work. And so while the Fed may be jawboning in their interviews, the reality is interest rates look like they're too high at this point because it's really stopped the housing market dead in its tracks, which is negatively impacting banks. Now you might say, well, Linda, how can that be? Because the banks are saying that they have record earnings. In fact, some banks did report that they had record all-time earnings just this month. How can that be when we know that banks have sharply reduced the number of mortgages that they're making, which is one of their main ways of making money? And in fact, some banks have closed down whole mortgage departments or refi departments. And we have reports of banks closing branches all over. So how can banks be at record profitability? Well, this quote from Peter Schiff caught my attention. I'm going to read it to you. Peter Schiff, of course, owning a precious metals company and being a commentator on economic news. And he said, for the first half of the year, Bank of America reported pre-tax income of $48.1 billion, yet ignored an additional $95.9 billion loss on its held-to-maturity securities. So, the bank actually lost $47.8 billion. It's in worse shape now than it was when it was bailed out in 2008. Thank you, Peter, for that quote, because that's my sentiment exactly. Some of the numbers are being ignored for losses that have occurred but are not actually being acknowledged. And so it's looking like they're very profitable and they're reporting big profit numbers. But the reality in the banking system is funds are flowing out into crypto. Very few mortgages are being made compared to 2 years ago. Their treasury portfolios are underwater because interest rates have risen. So again, perception versus reality is very different. So with the average 30-year fixed rate mortgage up at 8%, according to Freddie Mac, few people are wanting to buy and finance their home at 8%. So many people are buying for cash if they can, because 8% has really decreased the affordability of a home, and they can buy and afford much less than they could a couple of years ago, and people with lower rate mortgages want to keep those lower interest rates. That's keeping inventory off the market, and we're at 25-year lows for the amount of homes available for sale. That doesn't mean the housing market is going to crash or is crashing. You can't really crash when you don't have a lot of inventory for sale. You have a crash when everybody's selling their house at the same time. And I believe we're going to get some data that shows that inflation has indeed continued to drop, and that is going to bring interest rates down either at the end of this year or the beginning of next year. But we're going to see a trend lower in interest rates. And even the Mortgage Bankers Association has come out and said in 2024, they see a 6.1% mortgage rate by the end of the year. And in 2025, they see mortgage rates in the 5% bracket. I think those are conservative estimates, and we could be going below those rates because the economy has slowed so much, with the housing market basically coming to almost a standstill. This high yield on the 10-year Treasury is also impacting car loans negatively. It's also impacting student debt loans because they're all calculated off of the 10-year Treasury in most cases. The only group who benefits from higher interest rates are savers, people who have money in the bank or money in a money market who are earning at least 5% interest, which is nice that we have something that's paying a decent amount of interest these days. That's the most that savers have been able to earn in more than 15 years because we haven't had rates as high as 5% for that long. The only thing we can do really is wait. We have to wait for the data to come in for the Fed to see lower inflation numbers and for the market to adjust. Once the market sees inflation continue to trend lower and that's in the right direction, naturally interest rates will trend down. And that will be the opposite effect of the jawboning that the Fed has been doing to raise interest rates just by talking. So we're dependent on data, as is the Fed, and we'll watch the numbers. But I believe we're going to start seeing some lower inflation numbers, and maybe some that might even shock people, because there's quite a bit of the economy that has slowed because the housing market has slowed so dramatically. And that's important because we need interest rates to come down to re-stimulate the economy. Higher interest rates slow everything down, and we're even seeing car payment defaults hit a 29-year high as people who financed cars had the interest rates on their loans rise to 6.11% in September from a previous high of 5.93% in January, which has caused subprime auto borrowers to be at least 60 days past due on their car loans. I believe at some point the Fed is going to realize that they have over-tightened. They are too tight, interest rates are too high, and they're going to have to lower rates quickly to stimulate the economy, get people to start buying homes again, and other things that they finance. From these high interest rates, what we might see is the Fed actually causing a recession. And when that happens, they panic, they reduce rates, and the cycle starts all over again. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified of new podcasts as soon as they become available. And all of my podcasts are available on my website at lindapjones.com/podcasts. And while you're there, sign up for my newsletter for more wealth tips. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.